Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. I feel like real estate is always a hot topic, and with real estate comes mortgages. So as a financial planner, we need to be up to date on what's happening in the world of financing and mortgages all the time. My go-to resource is Erica Powers, and so we're going to have her as a guest here today. She is a lender at First Merchants Bank and is my expert consultant. She doesn't just do mortgages, she knows the field. She's been there through the ups and the downs. So she has all that experience, just like we like for our experts to have. Erica, welcome to the podcast.
Thanks, Melissa. I am happy to be here.
We are going to be talking about current mortgage environment and how that impacts you, whether you are buying a new house primarily, but also talking about refinances. It's just kind of a current state of the mortgage market for 2024. We're recording this at the beginning of the summer. I know this episode is coming out midsummer. We'll make sure to do any, updates as we go. But tell me, Erica, just to start, what is your kind of bullet point? Here's what the environment is today, analysis of the mortgage market today.
Sure. I would say that today rates, although they seem extremely high, historically, they're actually at an average of where rates have been over the past little over 50 years. So if you go back to the beginning of the 70s and look at from then until now, the average rate is around 7.41 for a 30-year fixed mortgage. And today the average rate is at 6.92. So we're still actually a little bit below where average rates have been over the past 50 years. However, average rates over the past 10 years have been below 4%. So when people are thinking about where rates are at today, they're feeling that rates are very high in comparison to their recent memory.
It's so interesting. Like recency bias happens in investing, where you assume whatever happened most recently is it's the biggest thing in your rearview mirror. And I think that there's an automatic assumption, like we're just going to boomerang back to where we were, and where we are isn't always the average of where we've always been.
Correct. And maybe we're getting back to a little bit more normalized rate. So this could be a rate environment that we see ourselves in for a longer time period than, a lot of people are thinking.
Do you feel like you can predict where we're going, or what do you say when people say where a rate's going to be in the future?
That I wish I had a crystal ball.
Same. That's what I say about investments.
Yeah, unfortunately, I can't predict that. So I think what I'm telling a lot of my clients who are coming to me and they're saying, well, I really want to buy or I really want to move. I'm sick of renting, but should I wait it out another year or two and see where rates are at? I'm telling a lot of them, if you're ready to purchase now, and if you're seeing homes in the price range that fits your budget, then I recommend that you move forward with purchasing a home currently instead of waiting for 2 years or waiting until rates come down. Because my concern is that when rates do come down, we're going to see even more of a flood of buyers into the market. We still may not have a huge amount of inventory. And so the limited homes that are available will be even more expensive at that point in time. So while you might get a less expensive interest rate, you will get a more expensive home. So if you buy now and you get lucky and rates go down in the next couple of years, then you can refinance and take advantage of the lower interest rate. But at least you'll have purchased your home at a lower price.
I think about that, and I know so many people want to be patient. They want to be price conscious. And when they see the changes in prices in real estate, they think, I don't think this is sustainable. Mm-hmm. But again, that's a prediction. And certainly, I think we live in Michigan where there really wasn't building occurring that met even a stabilized population demand. There wasn't like kind of upgrades to housing for a good amount of time. And we really lost with that the construction industry just in general. So we happen to live in a particularly scarce environment for kind of refreshed inventory when it comes
Yeah.
to housing
Yeah.
market.
I am speaking of this from a seller's market right now, where a lot of people are having to bid above
Yeah.
asking prices in order to win the house.
Well, how do people, so let's talk about that. So you see a ton of people. You have to get to know them very well because it's not just like, hey, I already found my house, but we're going to, we have a week to put in the offer. It's very much like in the housing market where we live near Ann Arbor, Michigan, and Metro Detroit. It's very much right now like you've got to be ready and know what you're going in with and know what your ranges are and know your escalation clauses. So, what are you seeing that helps people get not only put in a bid, but get the offer?
For all of my clients, I really recommend that they get pre-approved ahead of time. And with that pre-approval, that we're getting all of their detailed information. So they're submitting all of their documents to us so that we can be very comfortable with the loan that we're going to tell the seller that they're going to be able to qualify for. But also so that as they're going out and looking, they are going to also be comfortable with what they may have to pay because it's likely not the asking price of the home. So they need to be comfortable if they are escalating above the asking price, is that payments are going to fit in their budget. So we're having a lot of those conversations early on, but also as they're shopping, and people are putting in multiple offers. They're not getting the first home that they put an offer in on. So it is a little bit longer of a process. And then we're also trying to make our offer as competitive as possible. So closing quickly in a time frame that's more similar to a cash offer in case they're going against a cash offer. They're talking about doing appraisal gaps in coverage in case the home does not appraise for as high as the purchase price ends up to be.
What's an appraisal? Can you define an appraisal gap and exactly what that means?
Sure. So if, let's say someone's purchasing a home and the purchase price ends up being maybe the listing price of the home is $100,000 and the buyer ends up having to pay $125,000 for the home to beat out everybody else that is putting offers in on the home. But with that, since they're offering a higher price than the asking price, and if there are not a lot of similar homes that have sold for the same value, the home may not appraise for that $125,000.
And the bank cares about the appraisal, right?
Yes, we care about the appraisal. We are only willing to lend on the lesser of the appraisal value of the home or the purchase price of the home. So if the appraisal comes back at $100,000, but the purchase price is $125,000, then the buyer needs to pay the difference between the $100,000 and the $125,000 plus whatever amount they were planning to put as their down payment.
Okay, that's helpful.
So it's something to be really cognizant of, that if the home is going to appraise for less than the purchase price, are you going to be willing to pay that additional amount? And do you have those funds?
Interesting. What else can you do to make your offer look good?
I find it helpful to call the listing agent to explain that I've been working with the buyer, that I'm confident in their ability to qualify for the loan. And then also, like I said, a short time period so that you are competitive. I think that doing some of those things and in an escalation clause, to be quite honest, in a hot market is really important.
Can you define the escalation clause and what that would look like?
Yeah. So a lot of times I think people are used to the old ways where you would put an offer on the home and maybe you even put it less than the offer price. And then the seller comes back and says, oh, you know what? Can we meet in the middle of what you offered and what I had originally listed the home for? And you do a little negotiation. That's not typically how it's done anymore, because a home will go up for sale and then there may be 5 or 10 offers on that property in the first 48 hours. And so the listing agent will gather all of those offers up and they will call for best and final and tell everyone, put in your best offer. And then we're going to just look through the offers and determine which is the best offer. And that's who's going to win.
And now they're not supposed to tell your agent, this is what you need to beat or something like that. It's supposed to be kind of a fair game where there's not insider information.
It's a fair game. So a lot of people will put an escalation clause in that says, this is what we're offering for the price, but we're willing to pay up to whichever higher amount that they've chosen above, sometimes they'll put $1,500 above the highest price that you have received, the highest offer you've received, up to a certain amount. And so that's a way to say that you're putting the lower offer, but you're willing to go up to this if other people have bid higher for the home.
So then you don't have to overcommit if you don't have full information and feel like you may be putting in a really good offer, but you really want the house.
Yes. Yeah, because it's hard to say in this environment. And there are some houses that you think that your client put in a really good offer and they offered high above and that they're going to for sure win it. And then you find out that somebody else paid $25,000 more than that. So it's hard to tell in this market.
Well, there can be psychologically both, we already described the people that have just opted out of this and just said, I'm just going to wait until prices go back down. And it may be that the market isn't as hot, but they don't go down. They, stay stable. Who knows? We can't predict. Predicting that we have another 2008, 2009, I think we can talk about at the end of the episode, some of the kind of old wives' tales that are out there right now of people being overtaxed, but I don't see that necessarily. And things tend to not happen the same way they did in the past in the future. But you can then be like, well, I really feel like I could only afford a house that's 450,000. And then all of a sudden, because there's this tight market, you end up at 550. And I do think you need to be going in flexible and looking at houses knowing that there's a potential in our area at least of needing to pay over ask. But also then, be realistic. And this is one of the reasons I really like working with you. If you can't afford that, even if you can afford it for the bank's records, but let's say you're retiring in a couple of years and your income's going to change radically, or you don't love your job and you'd be willing to take a pay cut to work somewhere else, or it just feels too tight because you have other things that are a priority, then don't start looking at your max price and do consult with a financial planner like me or firms like ours, because we can actually put in all the other things going on outside of, kind of your housing decision in a way that's different than what Erica can do. And Erica can also be realistic and consultative. So one of the things I love is you're not just thinking, well, here's the very most I can lend to somebody, so let's aim there. You really want to be seeing people in the future and have them not be upset because they overtax themselves.
That's probably the most important thing to me is I don't want you to get into a home and feel house poor, that you are stuck in your home and you can't do anything else. So it's really important to determine before you are shopping for a home, what are you comfortable paying monthly, so that then we can back into that. And then if you're in a very competitive market, I am constantly telling buyers, if you want to end up paying $350, we need to look at homes that are $300 or below, so that you have room to escalate up to the top of your budget, versus looking at homes that are $350 and then escalating up to $400. That's not going to have you end up with the payment that you want.
I think that the ancillary costs are very important for you to be aware of as well. If you have a home that hasn't turned over in the market for many years and we have these changes in prices, then the taxes that the previous owner is paying are not going to be the same as the property taxes that you will likely be paying. And there can be radical differences between townships and cities and other, considerations between the tax costs of different homes. What are you seeing there?
I agree with that 100%. And I do think that it's good to have the conversation up front, because for mortgage purposes, we are qualifying you on what taxes are currently for the current owner of the home. So if you have someone that's lived in the home for 20 years and the taxes are based on a much lower value of the home, the minute you buy the home, they're now based on the new purchase price and they're going to increase, and you're going to get an increased tax bill in the next year.
They might even be double or triple, real increases of thousands of dollars.
It can be significant. So it's really important to ask those questions up front too, of what to expect, so that you can start setting some extra money aside for when your escrow changes or when your taxes are reassessed. and have a realistic expectation of what your tax costs are going to be and then what that's going to do to your payment.
I also know that this is we have to do an episode soon on homeowners insurance and property insurance, because this used to be kind of a throwaway of like, oh yeah, you're paying, for most houses, if unless they were above 3,000 or 3,500 square foot, was between $1,000 and $2,000. It was kind of like, yeah, it's kind of a pain in the butt, but definitely necessary. But for a variety of circumstances, the insurance industry is experiencing significant losses, including in the Midwest, from storms. And also, just like the economics of insurance is changing, and you better be ready to pay more than you might think.
I used to be able to very easily estimate what I thought the insurance would be. And I've been doing this I'm in my 20th year. And then recently I've started to see that the price is much different. So I do have some partners that I work with on the insurance side. And in talking with them, they have explained rates have increased a ton. And so now I have to estimate a much higher amount. But also, when I look at a lot of the listings, the amount that's estimated for the insurance is not adequate. So that's something that even when you're looking at a listing and it's estimating what the taxes and insurance might be, you need to add a little bit more to the insurance, because likely the value of what you're going to pay monthly is going to increase. I think it's also important to really talk to the agent and make sure you're getting correct coverage, because you find sometimes that clients
Yes.
will, because it is so expensive now, try to skip out on some coverages that you really need. If you have a basement, you should probably have some backup coverage in case you get water in your basement. There's other things. So it's important that you factor all of those costs in up front.
Absolutely. I couldn't agree more. And then when you get the actual statement of, the cost of the transaction, I just can't emphasize enough too. If people are like, yeah, oh, hey, I think I want to live here for 2 or 3 more years and then I'm going to relocate and things like that. And there's this assumption that I especially see this with divorcing people. There's this assumption that you're less than if you don't own a home at all times or if you rent. And even though you're in the business of helping people buy homes, Erica, I just don't, there's huge transaction costs from moving houses every few years. And so if you're not quite sure if you're going to stick around, like there's no shame in renting for a year. And a lot of these costs we're mentioning would be much less of a carry.
Yes, 100%. I think that when you decide if you're going to buy a house, it has to make sense to you and where you're at in your life and where your budget is. So you shouldn't just make the decision because you want to be a homeowner. It has to really fit your life.
And you may be able to, most of my clients own homes, but if some clients rent, and they may be able to have a bigger life outside of that real estate decision with a rental. So it's, everybody's circumstances are different. Even though at the water cooler or with your friends, they're like concerned for you because you're renting. Trust me, there are circumstances that are specific and unique to each person where it may make sense. Same goes for like maintenance. I always assume at least 1% of the cost of a home, but if you're somebody who's loving home improvements or just looking at a house that has not been updated, you need to be realistic about what you can do, when you can do it, and know that you can't just finish your very last project, years before you sell a house. Like I have some people who they're going to retire and they're like, well, I finished every single update we're ever going to need. And so, we won't have any other costs for the house. Just not true. You're going to need to replace a furnace. You're going to need to patch a hole in the roof. It's not all going to be covered by insurance. So please make sure you're including those assumptions.
Anytime I see a person who is telling me that they are going to put every dime they have down to purchase their home, I'm constantly saying to them, but you need to keep an emergency fund, because even if you buy a brand new home, I guarantee that 2 weeks after you move in, something will break. Something will come up at some point, maybe not within 2 weeks, but within the first year that you completely don't expect. And you need to have a contingency budget for when those things come up so that you're not charging that repair and then you're paying a ton of interest on that, or maybe you don't even have the room to charge that repair. So really important to set a safety budget aside.
I do. Yeah, you kind of carry that cost if you choose a condo in the association fee, although there can be unexpected assessments that you need to be prepared for sometimes. But I do think that, I will specifically accommodate for lower maintenance costs when you are in that condo where you don't have to take care of the exterior as much or do the landscaping and things like that. So those are also trade-offs that are, relevant to both of our work.
And honestly, people underestimate what update and remodeling to a home costs today.
So
Yeah.
true.
So it's
Yes.
important to be realistic about what those costs might be. If you're purchasing a home and thinking, oh, I'll just put in a new kitchen for $10,000, you probably won't be putting in a new kitchen for $10,000.
I mean, when people do it for 50, I'm shocked and like, how
Yeah.
did you do that? So it can be a huge expense. And I'm not saying we don't want to say no. I mean, you work with bankers who help do renovations, remodels, all of those, or
Yes.
you do them yourself. So that's part of your work as well. It could be another episode. So we're not here to say no. We're here to help people make educated
Yes.
choices and decisions. So I've heard some buzzwords. People are obviously like looking, they're reasonably anchored to we're in a much higher interest rate environment than we used to be and hoping for rates to fall. I'm kind of on the fence of that hope because that might reflect a weaker market and economy. And, that comes with some trade offs. But what are people doing to try to combat those higher interest rates? Are there strategies that could help you keep the interest rate lower for
Yeah, there's a
longer?
couple different products that some banks offer today. We offer what we call a temporary buy down. So you either have a 2-1 buy down, or you have a one buy down. So you're either having the seller pay for 2 years for you to temporarily have a lower interest rate. That would be on a 2-1 buy down. Or we have the buy down where the lender, ourselves, will pay for you to have a lower interest rate the first year.
And is it typically 1% lower?
It's 1% lower.
And is it 2% lower the first year and 1% lower the next year for the 2-1?
Yes.
Okay.
So, for example, if you were doing a 2-1 and the interest rate today is 7%, then the first year your interest rate would be 5%, the second year it would be 6%, and then the third year and thereafter it would be 7%.
And so somebody has to pay that cost. The seller would need to be willing to do that concession.
Yes, the seller would need to be willing to do that concession. So in our market here in the Ann Arbor, Detroit area, you're less likely to have a seller be willing to pay for that because it is a more competitive market. But there are other areas of the country that are not as competitive. So that could be a useful tool for a seller to offer to their buyer.
And you'd like if you were in this market, maybe a house that had been sitting on the market longer, or there's some reason it's unloved or something like that, that might be a consideration.
Yes.
What else do you have that could, get you potentially lower costs in the beginning?
Sure. So another option that some buyers are looking at, depending on where rates are at any given time, would be an adjustable rate mortgage, where the rate will start out at a lower interest rate for a set period of time. We offer all different levels, but it may be 3 years, 5 years, 7 years. And then after that, the interest rate will adjust for the remaining term of, if you're doing a 30-year loan, the remaining 30 years.
So you need to pay attention in those cases to how much it would potentially adjust and how frequently, right?
Yes. So for some people, we have people that sometimes move to Ann Arbor because they're coming to work at the university. And maybe they know they're only going to be here for a couple of years. Their contract is for a short period of time. They're coming to get some type of training and then they plan to move somewhere else. In their instance, if rates are lower on adjustable rate mortgage, it might make sense because they know they're going to live here during the time that the rate is lower, and then they plan to sell the home after.
Well, I was going to say, I don't think you need to know what you're getting yourself into going in. ARMs have a bad name, which is another name for adjustable rate mortgages, because they were overutilized in a lending environment that was really, I don't know, for lack of a better word, a boozy environment around 2005 to 2007. And almost everybody had arms. And then the shock of a lifetime, like interest rates went higher and people were stuck holding the bag on, things they weren't aware of that they were going to get themselves into and stuff like that. If you had a 7-year arm, for example, let's say that interest rates are still high. Well, that probably means inflation is also not super low, and the economy is pretty strong over that period of time. Well, the price of a dollar may be cheaper. A dollar might not buy you as much then. And yes, they may be higher, but you bought yourself some time and it may not be as punitive as you think. So I don't, keep that in mind.
Yeah, I think it's a tool. And for some people, it's a really great option. And for other people, it's not going to make sense.
You need to be educated
Yes.
on it and understand what you're getting yourself into.
Yeah.
Anything else that can be helpful for people to save? I know sometimes people may get a bigger mortgage and then make a big payment so that they're trying to reduce their cost, either to pay off the mortgage early or reduce their, kind of current payments.
Yeah, so that's always something that can be an option is if you start out with a larger mortgage and then let's say you get a large bonus or you inherit some money, or there could be many different things that come up, or you've just saved. You could put additional funds down in a larger lump sum and you could recast your mortgage. So you could keep your interest rate that you currently have, but you would lower your payment because we would amortize your loan over the remaining term based on the new lower balance.
I've also seen an article, I'll put it in the show notes, for some startup companies that are seeking to find properties that are for sale that have assumable mortgages. Assumptions come up sometimes if there's, for example, a divorce or kind of a change of hands, or getting one person off of a mortgage, something like that. But there are a few mortgages. So what is assumable mortgage first?
Sure. So an assumable mortgage would be a mortgage in which you would be able to transfer the ownership of the property to someone else and they would keep the terms of your current mortgage. So this has kind of been a popular term that people have started talking about because current interest rates for most people, a lot of people have a low rate in their current mortgage. So they feel that they could pass that low rate on to somebody else with them taking over the mortgage.
How many mortgages are assumable? Like, it depends, right?
It depends. And typically less mortgages are assumable than people think they are. So most people's mortgage is not assumable. A way people can find out if their mortgage is assumable is they can look at their closing disclosure from the last time that they purchased or refinanced their home. And on that closing disclosure, it says if the loan is assumable or not.
Interesting.
There are some exceptions to that, but you'd have to reach out to the lender or the servicer to see if they would make any exceptions to that. And sometimes the reasons for exceptions are divorce, some type of situation that's outside of the norm. However,
Interesting.
some other types of mortgages that are typically assumable would be an FHA loan or a VA.
Now, would the person assuming also need to qualify? So if you had a VA loan, you can't not be a veteran and then go in and get that loan, or?
Correct.
Okay.
So those are the ones that I mostly see listed. I've seen a couple of them where someone has a current VA loan and they're saying, hey, you could assume my VA loan, but you need to qualify for that VA loan.
And I would assume that the price might be a little richer for the house if you could, in the case of like all the stars align, you have an assumable type transaction, then A, you're going to need to fully qualify for that, just like the originals did, and B, the price may be higher on that home.
Correct. Yeah, so that's something to keep in mind is that when you're trying to assume the mortgage, you still have to go back to that mortgage company that holds the mortgage currently, and you have to now qualify based on the terms of the original mortgage. So you're not able to just take over the mortgage, sign a paper, and suddenly the house is yours. You're still qualifying just like you would for any mortgage. So
okay, perfect.
And sometimes there's high fees involved with assuming another mortgage. So you have to take that into account too, because if they're too high and you're not going to recoup those fees over the time that you're going to own the home, then maybe the assumption didn't make sense.
Thank you for saying that because our next topic is refinances, and you have got to not only be focused on any of these conversations, do not only focus on the interest rate, because built into the transaction and often added to your loan are embedded costs, and those embedded costs have to be factored in. So when we get into, what many people are who have recently gotten mortgages are hoping to do, whether they have an arm that has, a clock ticking, or they're just at a high interest rate, is they want to refinance eventually if rates go lower. So, what are you talking to people about in order to prepare for when there is a time? I think you've actually done a few refinances, haven't you, recently?
I have actually done a few refinances this year, because I had some people that purchased when rates were even higher last year. And so it actually made sense to refinance this year. But when we look to make sure that it makes sense to refinance, we're looking at the costs that they paid when they first obtained that last mortgage. Have they recouped those costs? And then taking into account, if you're incurring new costs, how much is the savings that you're going to be seeing on the new interest rate? And then how long will it take you to recoup those costs as well? So it's really important to talk to someone who's taking all of those costs into account, because there sadly are some people in our industry where you call and they'll just do a refinance for you without taking those things into account. Also really important that if you're looking to refinance or even looking for a purchase mortgage, that you ask for the details about the fees involved, because sometimes if the rate seems too good to be true, it likely is. And so you need to see all of the costs, and that could be impacting why you're getting offered that rate, but those costs could be extreme.
It's probably not going to make sense to refinance when the rate is a quarter point lower or point 0.5 lower. You need to have a bigger spread. And like both of us said, the costs do matter. There are closing costs. And you're also resetting the clock. Like, let's say you've had a mortgage. This is probably isn't relevant for most people right now, but for 5 years and you need to refi. When you refinance and you set a new clock for 30 years, you may still be adding more costs unless you start to pay this a similar amount so that you end up paying it off more quickly.
Yeah.
That might be okay, but you need to be aware that of the way the math works when you refinance. Maybe, in some cases, people that had mortgages from the early 2000s, they might have refied into a 20-year mortgage if it had been 7 or 8 years since they refinanced, and they still got a lower payment, but they also in a lower rate, but they also didn't reset the clock on when they'd have it paid off, and so saved some elsewhere.
Yes. Yeah. It's really important to look at all of the numbers, and it's important to talk to a loan officer who is going to take the time to look at all the numbers and make sure that it makes sense.
So I also wanted to dispel some rumors. I hear when people are talking about the economy in general, a couple things. One is like everybody in America is swimming in debt. I can't believe, like how bad their balance sheets are, how much they have in credit card debt. Now, when I look at like Federal Reserve data on either credit card debt, mortgage debt, et cetera, that's not what I see generally. But what are you seeing with borrowers, and how difficult are the lending standards? Or are we just giving money to everybody that walks in the door, or is it more difficult to qualify than it was 15 years ago?
I think it's probably more difficult to qualify than 15 years ago, because we had some types of mortgages that maybe we shouldn't have been doing. However, I'm not necessarily seeing that all of my clients are swimming in debt, but that doesn't mean that there aren't some out there. I haven't necessarily seen a huge uptick in people having a ton of debt. And
Well, many people have very low interest rates on their mortgage. So even if they've borrowed more because the prices are bigger, the property values are going up, there's equity in these homes, and their payments, this is part of the reason that the inventory is going to be less for longer, is they, when you're sitting on a 2.5, 3% loan, you don't want to give it up and switch it to a 7%.
yeah, that's why I don't think that we're going to see some of the same scenarios that we've seen play out historically in the past, because people aren't going to be willing to give up the current terms that they have.
The other interesting thing is I've heard statistics or assumptions that you can like all it is wealthy people changing hands of houses, and you can't be a first time home buyer, for example. Oh, woe is me for the millennials and Gen Zers, because there's just no way to be a participant in today's market. Now, I see those people as clients who are making, in many cases, really good money with their education, even if they're carrying student loans. They're being compensated with equity compensation, which is also driving the market. Are you doing loans for only, the olds? like I think I might be a part of that group, or are you also doing loans for first time home buyers and things like that?
We're doing a lot of loans for first time home buyers. And I think one of the, I don't know, old wives' tales out there is that you have to put 20% down. So you have to have all of these funds saved to be able to purchase a home. And that's not true. You can purchase a home we have programs that are just 3% down. And we also have down payment assistance programs. There's a lot of down payment assistance funds that are available to first time home buyers that can help them get into a home and bridge the gap between what they've saved and maybe what they need to save to get to where they need to be. So I think it's really worth it to reach out to a lender if you're interested in buying, even if you don't think that you have saved enough, to see what options you might have available, because you might be surprised that you could be ready to purchase a home.
Well, that's one of the things I really emphasize to people. Like, one thing I would be telling them right now, if they haven't bought a house but they think they might, make the phone call sooner. I mean, you guys are busy as mortgage originators nowadays, but not as busy as you have been in some of the refi times. Also, I'm assuming, and I've actually sent people to you that you didn't do their original loans. You've got a list going of where everybody's interest rates are to be looking for the right time to do refinances. Like, you should tell your lender now, hey, I mean, hopefully they know if they originated your loan, but if not, get on one of those lists.
Yes. I think it's really important. If you worked with a good loan officer, then they are going to be constantly looking out for opportunities for you so that when the time is right to refinance, they're going to reach out to you and say, hey, I think it's time for you to take advantage of looking at some other options. So I think it's important to always be having the conversations and keep in touch with your loan officer, and hopefully they're keeping in touch with you too.
Well, Erica, thank you for being a voice of wisdom in an area that is constantly changing. Is there anything our listeners need to remember as we're signing off?
I guess what I would say is don't be afraid to reach out to a loan officer. If you have questions about the process, or if you're really not sure if you could qualify, you can always call and have a conversation. There's nothing stopping you from doing that and getting the information so you can be a better informed borrower.
Well, and I would say that your loan officer should be proactive and consultative. It shouldn't, if it's done right, it's not a transactional deal, a sleazy sales pitch. It's not something where they're not putting, the lender isn't putting themselves in your shoes and trying to advise you for what might be in your best interest. And Erica, just an appreciation for all the thoughtfulness that you bring to that conversation. Thank you for listening to the Women's Money Wisdom Podcast. If you found value in this episode, the best way you can support the podcast is to forward an episode to a friend or leave a review. Go to pearlplan.com and the podcast link to get all the resources and links mentioned.